Hey everybody, Derek Nelson here. I am the founder of the Polaris Financial Network and author of the book Financial Foundation System. That book, by the way, you can get it on Amazon today, or you can click the link that I'll put in the comment section and get your free ebook. So I want you to like, comment, and share this. I think this is super important information that I'm about to share with you. I'd welcome all comments. I want to open the discussion up. If you're watching this on YouTube, make sure you subscribe to my channel. And we need to share this message because, especially today, I want you to understand the financial impacts of the COVID-19 pandemic. Now, here's a question, and you can feel free to answer this, or maybe you just want to think about it. But do you think that COVID-19 caused an economic crisis, or did it just uncover one? I believe things are going to get real bad. In fact, just yesterday I read an article that Nashville, Tennessee just approved a painful 34% tax hike. Many companies and Americans couldn't even pay their bills 1 month into this crisis. We are expecting, and don't be surprised, 50% of restaurants, bars, and retails will never open their doors again. To compound things, we have a record number of people turning 65 every day. Yet, because of all the people out of work and all the businesses not operating, think about the FICA tax revenue that's been lost. For those that don't know, FICA tax is a tax that funds Social Security and Medicare. Between the lost revenue and stimulus money being handed out, we are in big trouble. We can expect higher taxes and lower benefits in the very near future. Here's a few things to consider. I really don't think things can be done the way they've always been done. We need to make some serious changes. I want to move into retirement plans because a lot of you do contribute to retirement plans. And my philosophy is saving somewhere is better than not saving at all, right? But let's take the 401k, which is the most popular plan out there. Let's say you are contributing $10,000 a year and you're in a 12% tax bracket federally. Let's just say between federal, state, local governments, what have you. Let's just round it up. Let's just say your taxable income is 20%. That means when you contribute 10 grand, you're saving $2,000 in taxes. We can agree on that. Now, what's going to happen if taxes are going up? What's going to happen to your money when it comes time to take distributions? Now, keep in mind with retirement accounts, if you take the money out as an income in retirement, every penny's taxable. If you don't need the money, the government will force your hand because they want their tax money. You will have to take distributions or you'll actually pay a penalty. Now, if taxes are going up, what does that mean for your 401k, your IRA, what have you? Here's what it looks like. If tax rates go up to 30%, well, when you take distributions out, it's going to cost you $3,000. At 35%, $3,500, and at 40%, $4,000. This means when you're in the distribution phase in retirement, it's going to cost you $1,000 to $2,000 for every $10,000 you take out. Now compound that over 20, 30 years in retirement. What is the cost to that? Another thing to consider, what if the market doesn't return? What if there's no returns over the next decade or so? With everything going on, is that possible? Of course it is. In fact, we might see significant losses in the market over the next decade. Remember this, $50,000 today, assuming a 5% inflation rate, is worth $47,500 tomorrow. Now compound that over the next 20 years. This is why I really, I talk about this quite a bit, and I really think you should consider, especially now with everything going on, is a properly structured cash value life insurance policy. Let me explain to you. When I design these, it's for maximum cash growth. However, I'm not promising grand slams. We're not swinging for the fences. I'm not going to tell you, hey, if you put $5,000, $6,000, $10,000 a year into this, that you're going to magically become a multimillionaire. My job is not to make you rich. My job is to prevent you from ever being poor. Let me explain how it works now. When you start contributing into a policy, and full disclosure, for the first several years, it doesn't look all that attractive. Here's why. If I took out a policy today and I put $10,000 in for the first year, that $10,000 might only be $7,000 next year. That's what it might show. But if I pass away, my wife will get $500,000. So that's why there is a cost of insurance, and over years, that turns the table. Now, you go out 20, 25 years, you will have guaranteed growth. You'll never lose money. If the market's down 30, 40, 50%, you have guaranteed growth. You also get to participate in the dividends of the insurance company. So this is the tortoise versus the hare method. So while, yes, you could make 15, 20% in a year in the stock market, you could also lose 15 to 20%. I just bump up very slowly, slow and steady, slow and steady. Now, to compound things with the life insurance, there's something called waiver of premium. If you become fully disabled, the insurance company will continue to fund your policy. No mutual fund does that. When you need access to your money, there are no IRS penalties, there are no restrictions. When you get into retirement, as needed, you can take withdrawals and loans from the company, and your retirement could be completely tax exempt. You'll never be subjected to a higher tax bracket, at least not with the part of the life insurance, because that part of the money you take will be 100% tax exempt. And if there's ever any long-term care needs, there's something called chronic illness, which allows you to stay in control. You can use the death benefit if you need long-term care. You just have to not be able to do 2 out of 6 daily living activities. So, for example, if you eventually, like you couldn't get dressed or bathe yourself, you would qualify for that. You always have access to the money. And at the end of the day, you could be safe and know that your money growth is guaranteed. It will be there. You'll never pay taxes on that money. You'll never, when it gets close, when you pass away, you'll never have given all that money to hospitals. You won't have to give your life savings to the IRS. You can keep it in control, and you can keep that money within your family and pass it to the next generation. Again, please like, comment, and share. Here's my information if you want to reach out and have a conversation, or you can shoot me a message directly. I'll talk to you soon. Have a great day.